All right, so I'm now here with Samir Sonti. He is an assistant professor of urban studies at CUNY's School of Labor and Urban Studies. He also has a new piece in the latest issue of Jacobin on inflation. Samir, good to see you.
Thanks for having me, Jen. It's a pleasure.
So, inflation, obviously, an ongoing problem in the US. I think concerns about inflation have sort of dominated public opinion polls over the course of this year, maybe even a little before. We've covered inflation a little bit on the show before, but just to dive into your piece, I was wondering if maybe you could sort of talk about the causes of inflation. What exactly is going on right now?
Sure. I think if you're going to talk about inflation right now, you have to start with the pandemic a couple of years ago. Supply chains is a term that maybe wasn't in the popular discourse a few years ago, but now everyone knows what they are. It got disrupted during the pandemic, and that was bound to create a lot of problems. I mean, shutting down a global economy is an unprecedented event, and restarting it's not going to be smooth. We maybe should have expected this at the outset, but many of us didn't. In any case, now looking back, it's clear that that's where this all started. Of course, it's been intensified recently by what's going on in Ukraine and the reverberations of energy markets from there, and now a potential food crisis, and so on. But this is really, to put it in a word, this is a supply issue and not a demand issue, as I think some conservatives and many neoliberal economists would suggest.
So, I want to talk now about what the response to inflation has been, because obviously, back in March, the Fed had their meeting and they decided to raise interest rates. How have inflation and, by extension, the economy changed since then, if they have at all? And, the Fed is obviously talking about raising interest rates again. What is going to be the consequence of another rate hike?
Yeah, it's a good question. And if we knew the answer, we could probably make a lot of money betting on it. But, the short answer is the reason that the Fed raises interest rates to combat inflation is with the intention to slow the economy down, generate unemployment, and thereby, hopefully, in their mind, reduce the inflationary pressure. Now, this presumes that the source of the pressure is demand, right? Excess demand, workers' bargaining power, and so on. But the reality over the last few months is that workers' real wages, which is, their wages adjusted for inflation, have been declining. So this isn't a wage price spiral that's been set off by Biden's economic policy. This is, again, a supply side issue. And the Fed's traditional policy response, which is, again, raising interest rates, can't get at that. It can create a recession. It can slow the economy down, increase unemployment, but it can't get at the underlying cause of the inflation. Now, this isn't to say that this is what's definitely going to happen. The Fed has moved somewhat gingerly, though they seem to be getting a little bit more hawkish as the weeks pass. And the question is going to be how hawkish they get. And there are more hawkish forces on the Fed and less hawkish forces. And Jerome Powell, who again was a Trump appointee who has been reappointed by Biden, started out somewhat cautious and is getting more and more militant about trying to control it. So the question is how far they go. If they go far, then I think we could very well see a downturn in the next, year or even months. If they continue to move gingerly out of concern for the effects on the economy as a whole, then we might not. But I think the point is that the Fed responds to inflation by basically taking it out on workers, trying to undermine workers' bargaining power, trying to slow things down to generate unemployment and thereby address it. And this is not the kind of inflation that'll work with. So that's where things stand. And it's not a great outlook.
I think something else that is interesting is we've started to hear a number of growing concerns that the U.S. might soon experience stagflation, as it did in the 1970s. So maybe talk a little bit about what exactly stagflation is, how it played out in the 1970s, and then obviously, the follow-up is it likely that we could see this again?
Sure. So stagflation is kind of an obscure term. It was coined in the late 60s and gained purchase in the 70s. And it referred to this phenomenon that occurred during the 70s of slowing down economic growth, recession at a certain point, rising unemployment, and inflation, the coincidence of those two things. The mainstream story, and I don't think this is actually borne out in the historical record, and we could talk about that perhaps. But the mainstream story is that in the late 60s and early 70s, under the Johnson and Nixon administrations, there was a presumption, and this came out of Keynesianism in the post-war period. Keynesianism being kind of the dominant macroeconomic theory of the post-war period, that there was some kind of trade-off between inflation and unemployment, and that you could target a certain level of unemployment and try to reduce it if you were willing to tolerate a bit of inflation. The reality is that very few economists ever really believed that there was a strict trade-off. Most unions didn't believe there was a strict trade-off. It wasn't as universally held as a belief as it's now presented. But that's the story. And the story, again, the mainstream story goes that under the Johnson and Nixon administrations, unemployment was targeted at a very low level, and at an irresponsibly low level, as some like Milton Friedman would say. And there were a lot of reasons why this was the case. One was Vietnam, the need to spend to produce military armaments for Vietnam. The other was just basically electoral calculations, trying to get unemployment as low as they could before the 1968 and 72 elections. And the story that Milton Friedman, for instance, who was a right-wing economist at the University of Chicago, the story that he popularized was that this irresponsible macroeconomic policy set in motion an inflation. The inflation then raised expectations among everyone, workers, businesses, consumers, and so on, that inflation was going to continue. This led workers and businesses to bid up wages and prices and set off a wage price spiral that got out of control. And, once it was out of control and once inflation was out of control, businesses were reluctant to invest. They're worried about, there's so much uncertainty in the air. And so the propensity to invest drops, and that leads to an economic slowdown. And so now you've got recession and inflation going on at the same time. The reality, I think, is a lot more complex than that. This is somewhat of an ideological interpretation of what happened. Really, I think what economists at the time, what unions at the time, and still today were pointing out was that the inflation of the 70s was principally driven by supply shocks, an oil crisis that began in 1973 due to the OPEC embargo, a food crisis, other things as well. Like the dollar was devalued, was taken off gold in 1971. There was a worldwide productivity slowdown that began in the late 1960s. A bunch of complex dynamics that were wound up in part with sort of the structure of capitalism, in part with random contingent events, led to the inflation to take off. And once inflation, a supply side inflation like that can very well, as people then understood, coincide with economic underperformance. This has nothing to do, again, with demand. You could have an oil price spike that leads prices of everything to start rising while the economy is not doing very well. And I think that is the most relevant part of the 1970s experience for what we're going through right now. The way that all played out is, and through the 70s, there's a debate over this. What's causing this? And there was a reluctance to overreact to it with excessive, austerity. Though there was a fair amount of austerity through the 70s. Paul Volcker, who's the chair of the Fed in the late 70s, is most infamous for imposing a really harsh monetary austerity in 1979, but even earlier, 1974, their interest rates were double digits, and in the late 60s, interest rates climbed pretty high as well. So it wasn't like this was some reckless macroeconomic expansion that was allowed to get out of control. There was austerity, but the notion that you could try to combat this with a brute force dose of monetary medicine was not widely accepted through much of the 70s. So there were forces who were arguing for it. It's not until 1979 when Jimmy Carter, who's a Democrat, appoints Paul Volcker to lead the Federal Reserve, and Paul Volcker, at least for a time, embraces the Friedman argument. I'm not sure that he ever really believed it, but he understood its utility, and raised interest rates to close to 20%, and that triggered a deep recession in 1980, 81. From which, working people here have never really recovered. That set off a debt crisis abroad, and that's how it was resolved. So that's the story of the 70s. In terms of, to answer your question about whether we could see that again today, I think, again, the lesson that supply shocks can create stagflation or can lead to something like stagflation is the really relevant kernel of that story. And we've obviously seen some supply shocks. I think we may be in or entering a world in which these could be more common with climate crises, weather events, ongoing pandemics, geopolitical tensions that disrupt trade relations, and so on. So it's certainly possible that we could be entering a stagflationary environment, but not for the reasons that, someone like Larry Summers, for instance, might say.
Yeah. Well, I do want to ask you about the possibility of recession also, because, I'm sure you've seen the news lately. Plenty of billionaires, I think, Elon Musk, Jamie Dimon among them have basically indicated that they believe a serious recession is just around the corner. Elon Musk famously said he, quote, has a bad feeling. So should we have a bad feeling? Should we be concerned? And then, like, as a follow-up, obviously a recession means something totally different for billionaires than it does for, like, everybody else. So what exactly would a post-pandemic recession look like for most working people?
Yeah, well, again, predictions are tough, right? And so it's hard to say. But I think given the way so recessions happen under capitalism, right? Yeah. Capitalism is a cyclical, or is a system that operates through cycles. So recessions always happen during capitalism. The question is when they happen, how severe they are, and what causes them. Right now, I think we need to think about a potential recession in terms of the agent that would actively create that. And that's, again, the Federal Reserve. Mm-hmm. It certainly is possible, again, given that inflation is stemming from supply issues and can only really be alleviated through supply measures. It's likely to persist. I mean, it may decline some, but the risk of a persistent inflation is certainly greater than what we thought it was a year ago. And that, as long as the Federal Reserve's response to that is through a tight monetary policy, right, raising interest rates, a recession is, I would say, likely. Now, again, the question is whether they choose to pursue that course, given the risks that they very well understand as well. And that's an open question. And they're kind of a black box, and it's hard to say. But it does seem, based on the way that what they're projecting, that they are intending to get only more hawkish on this. So we could well see one. Now, what does that mean? Of course, it means billionaires might see a little haircut in their asset, in their wealth in terms of measured by asset values. But what it means for working people is unemployment, right? It means that this somewhat remarkable recovery in terms of job growth and wage growth that we've seen over the last year would be reversed. How severe it gets depends on how harsh the policy reaction is in the first place. But working people always bear the brunt of it. And recessions not only result in unemployment, but they also place budgetary strain on state and local governments, which are, as we learned in the last crisis and after 2008, typically responded to with austerity there, which only worsens the pain. So that's the unfortunate reality of what we're looking at, given the tools on offer.
So maybe then I want to wrap up with kind of a political question, because as I mentioned at the beginning, the issue of inflation has been dominating public opinion polls. It seems like it could very well shape the upcoming midterm elections. So I also saw recently that Joe Biden talked about fighting inflation by trying to reduce the federal deficit. So I guess the last question for you is, like, how would Democrats ideally respond to the ongoing problem of inflation and the threat of a coming recession, especially as we're coming up to midterms?
Yeah, this is kind of the $1 million question. The budget deficit point is an important one, right? The standard toolkit is we talk about the Federal Reserve a lot and tight monetary policy, but the other side of that is a fiscal retrenchment, right? Reductions in federal spending. The idea being that budget deficits result in inflation, and that's a complicated topic that is probably beyond the scope of this discussion. But that's where that's coming from. That's sort of older orthodoxy. The ideal response, and as those of us who are committed to working class politics, those of us on the left, I think need to think about inflation always, first and foremost, as a broadly political issue, but specifically as a class issue, a distributional question. Inflation, well, the prevention or control of inflation, let's say, always requires limiting certain kinds of claims on income, which is a somewhat abstract thing to say. But what that means, to just unpack it a little bit, is either wages have to be limited or profits have to be limited. One of those two things has to happen. And over the last few decades, inflation has been prevented largely through suppression of wages, right? We've had wage stagnation for a long time. We haven't seen much consumer price inflation over the last few decades. The last time, in the late 1970s, inflation was brought down through really harsh repression of working class power. So the alternative is, well, could we think about controlling profits? And there are ways to do that. In the immediate term, things like an excess profit tax are on the table. Sanders has endorsed that. Elizabeth Warren's introduced something, price gouging bill. People are talking about price controls as another option. These are all ways to get at the underlying, class question and place the burden of inflation control on capital. I think we have to, and those are all things that, we should be, I think, fighting for. But the next step there is, if we were to control profits, right? If we were to limit profits and try to manage inflation through a limitation on profits, you do have to confront the question of what comes next. Insofar as profits in some ways lead to investment, right? We live in a capitalist society in which business profits lead to investment to some degree. If you suppress profits, you're likely to see some shortages in certain areas, and perhaps, underinvestment that generates unemployment. And that's something that I think we need to reckon with. The question is what we would want to do with that. And that raises the question of the state, the public sector, stepping in and doing more to provide basic necessities, doing more to plan investment, to take control over investment out of the hands of private economic actors, and, democratizing that function. And now we're talking about capitalism as we know it, right? So I think the real way to think about inflation is not just some technical issue that we got to figure out how to manage, but something that raises the really big questions about the political economy that we want to have, and who controls it in whose interests.
All right. Well, again, Samir's piece is in the latest issue of Jacobin. We will link that below. Samir, thank you so much for your time. Good to see you.
Thanks so much, Jen.
If you like this video from The Jacobin Show, please hit like and subscribe and share with your friends. Thanks.